I'm 92.90, 10 by 10. Yours.
Mine.
99 at the buck. Welcome to the OpenYield Markets Podcast with your host, Mark Hebert.
Welcome to another edition of OpenYield Markets Podcast. I'm your host, Mark Hebert. Today, we are very happy to have on Tim Jennison, who has spent an illustrious career on Wall Street. Overseas and at Morgan Stanley, when I first started, he was the head of EMEA Credit Sales. He was also an SRM for the bank. And then he spent some time at BCG in consulting. So we're really thrilled to have, and if you don't know Tim Jennison, he kind of looks a little bit like Daniel Craig. So today we have on the James Bond of the credit space. But we're really thrilled, Tim. So if you wouldn't mind, I just gave an extremely brief overview of your career, but let's just start with the beginnings. How'd you get on Wall Street? You put out a great LinkedIn post a few weeks ago about how you actually got rejected at Morgan Stanley. But if you could just tell me about and then you got hired there because it was a dream of yours. Tell me a little bit about the beginnings of your career and how it kind of matriculated to where you are now.
Thanks. First of all, Mark, thanks for having me. It's a real pleasure to be here. It's great to see you again, and brings me back a little bit actually to have a conversation with you to some of the things we used to do together on the trading floor.
Absolutely.
Yeah, I kind of so look, this is going back 34 years now. I came out of grad school in 1991. I wanted to work for Morgan Stanley. Actually, it was very company specific at the time. There was a very powerful investment banking lady, a real pioneer in the field, who was working in the New York office of Morgan Stanley at the time. She ran the restructuring business there in IBD, and she was an alum of my university, Johns Hopkins, and she was recruiting, but she'd never actually managed to onboard anybody into the investment bank from this international relations school that I was studying at, because people tended to fall between two cracks, right? They tend to be fairly mature because they're at grad school and they have a fairly eclectic internship experience collection, etc., but they don't have the MBA type of profile that Wall Street really looked for at the time. So she'd never really been successable in actually onboarding anybody from the school into Morgan Stanley.
And an MBA from Hopkins, to be clear, right?
They do now, yeah.
Yeah.
They have a joint. There's also there was a joint MBA program with Wharton at the time. I was not part of that. I just did a international relations degree in European studies out of Washington D.C. But she came recruiting, and we got along really, really well. And she invited me for 40 or 50 interviews between London and New York at the time. And I really, really wanted to work there because I felt everybody that I met was very, very high quality. I think it was dovetailing quite nicely with some of the geopolitics and some of the things that I'd been studying. But I didn't get it. I didn't get the job, but the firm had made such an impression on me that I kind of swore to myself I'd try again at some point. And then I got a job post grad school, actually in New York, working for a bank called BHF Bank. It was a German merchant bank where, again, the leader of the North American business was a Hopkins alum, and he hired me into the treasury area to be a foreign exchange forwards trader. So that's how I kind of, in the trainee program at this bank, it was a reasonably prestigious trainee program, especially in the head office in Frankfurt. And within a year, I'd been relocated then to Frankfurt to start trading swaps and money market instruments, but also the Deutschmark swaps at the time. That was a pioneer market, and that's how I kind of got into the market space. I didn't really want to end up at this bank. I wanted to get back to Morgan Stanley or something similar, of course. And 4 or 5 years later, that happened, and I was hired into London at Morgan Stanley as a fund brief covered bond trader, right, on credit desk, working for a gentleman called Jim O'Brien. I don't know if you remember Jimmy.
I do, yeah.
Fantastic individual. Yeah, that was the job that I got at Morgan Stanley, and I just absolutely went for it, right? That was 1998, I think. First day that I got there, by the way, I had lunch with Nanine, who was the investment banking leader that had tried to hire me originally. It was just a really, really nice thing to do, I felt, and she invited me to lunch on the executive dining room. The whole world opened up. It was just great, right? So I've been working for, reasonably competent, but fairly slow, bureaucratic and bureaucratic German institutions on trading desks there, and then finally I'm coming to Wall Street. This is going to be great, right? So that's how it all started.
So over your time at Morgan Stanley, which was around 20 years, you worked in many different geographies, right? You traveled a little bit. You oversaw some regions, the whole EMEA region. How did your career evolve from that first spot into, management and also taking you to different places around the globe?
Yeah, I'd say collectively it went from very narrow to very broad over the 18 years that I worked there, or 17 and a half. I think in the beginning it was reasonably micro-tactical, right? You trade a book, you cover a client, you focus on maximizing your product space and getting paid for it.
Yeah.
Same whether you're trading a book or you're covering a client group. And then as time went on, things got more strategic and more macro. You were solving client problems. You were bringing the bank together between investment banking and markets. The things that I worked on towards the end, probably in the last 5 years after the financial crisis, were very much problems that bank clients had around their bad portfolios. So this became very, very strategic, and these were CEO topics. So you couldn't really tackle them on behalf of fixed income without bringing the investment bank and the bankers into it. So forging relationships with our IBD division, and really pitching jointly for transformational types of situations was kind of where this ended up in the last 4 or 5 years of my career at Morgan Stanley.
Yep.
I think these were the good parts, and what was more difficult towards the end, specifically after the crisis, was that as you advance into more responsibility, it's more difficult for you to really stay close to clients. Especially with the regulatory burdens that were coming post-financial crisis on managers, on leaders, and on people that were running businesses, right? So this is a big dilemma, I think, for manager-producer types, because you need to work on the one hand in keeping your key assets. What are key assets? It's risk, it's P&L, or it's clients, right? And if it's just pure management, then you're expendable on some level, but you still have to do that work. So you have to find that right balance of being able to fulfill your regulatory obligations as a risk taker or as a senior manager or whatever it might be, and the need to stay close to clients and risk. Right? So that became, so I would say towards the end, that was a more challenging balance to manage. And the joy of really doing the things that I like to do, which was solving client problems, bringing the bank together, and obviously executing meaningful transactions to make sure that stayed in focus, right?
Yeah, it's really interesting that you say that. Is you spend so much time coming up in a career focused on clients and how the clients work in the ecosystem, whether you're in a sales seat or a trading seat, or even in an algorithmic seat today. It still all focuses around the client. And as you become more senior and you transition to what I call the player coach, or what you just said, I believe you call it the manager, trader, if you will. Like when you get that hybrid role, it's very difficult to realize that the clients are still the real reason that you come to work every single day. However, you start getting pulled in all these different directions, whether it be regulatory, risk meetings, hiring, which is, like getting the talent for the next generation. But all of that time that you do in all these meetings and all these other things does take away from why you started this job to begin with. So I realized it myself when I ran a sell side desk, that you do get pulled into all these meetings, and your lifeblood is the client at the end of the day. So it's very interesting to hear you say something similar in terms of, the transition from player to player coach to coach or to leader. So it's an interesting transition.
Yeah, I think it's difficult for many people to manage this. I think there are some very, very exceptional leaders, right, that actually, through the power of their personality and their abilities and their leadership skills, are justified and probably the right people to be in a purely managerial seat.
Yeah.
But there are very few of them. I think as you and I grew up, you normally get promoted based on your performance, potentially beyond your leadership capabilities, right? So all these things sort of end up coming together at some point and have to be solved.
Yeah, a lot of times you get promoted based on solely on your performance without a real lens into whether you make a good leader or not. It's just the path forward, if you will, but without really doing work on whether this person would make a good leader. But we know they're a good performer. Some people are meant to be just good performers or good producers their whole life.
I think it's a question of how you can, what tools you have, and how flexible you can be in those incentivization tools. If comp is not a big tool, then a leadership position or some hierarchical job
Right.
title, whatever it might be, is more appealing. If comp is a very, very flexible tool, then on some level, perhaps um, you can steer people into what they're best at.
So I think we're almost doing a natural segue into the next thing I wanted to talk about, which is your time at BCG, your time in the consulting field and what you did there. You led global work in capital markets. What were some structural shifts you saw from the other side, working with BCG and probably having clients that were in former, banks and other financial services clients? What was kind of the structural shift you saw, or the ways that you were able to use your previous career to really help you in your consulting roles?
I think broadly, maybe just to explain how that setup worked. There were really two types of businesses that I was responsible for at BCG when we talk about leading work in capital markets and investment banking. One area is what I would call hardcore capital markets and investment banking clients, the Wall Street institutions, for example. They don't need a lot of help on capital market strategy. They're very highly paid people that do these types of things and should be doing those types of things. There, it's more about delivering the capabilities of BCG in other areas, whether that's risk and compliance, whether that's more the ESG space, whether it's digital transformations, or whether it's cost cutting, which is usually a big staple of consulting work. That's what they would more look to BCG for, or at least to the consulting world for, rather than what we would call pure strategy work in the investment banking and capital market space. When we look at let's call it the tier 2 to X banks, so I had this, so just to go back again, so I had this sort of dual role where on the one hand, I had some responsibilities for these types of clients across the breadth of the BCG offering, right? So the Wall
Yeah.
Street or the bulge bracket firms, but more outside of the pure capital markets investment banking space. It's more of a relationship management role where I'm delivering the firm BCG to these clients. And then in let's call it the tier 2 to X type of
Yeah.
banking space, sort of the global regional, sorry, the regional universal banks, the global universal banks, or the regional CIBs and these types of organizations. There it's more about investment banking, capital markets, CIB, corporate and institutional banking, or commercial and investment banking, bringing these organizations together, making them more efficient, and actual real strategy work around how they're set up in their markets and investment banking and corporate banks, right? So that's that's sort of the setup. So when we think about the first group, a lot of it was really more about benchmarking digital capabilities around risk and compliance excellence, around potentially cutting edge topics around how to stay current on regulatory affairs or ESG types of things, or where the division might be involved in a broader transformation, like we did at one bulge bracket firm where we're running an agile transformation for the entire organization that touches the investment bank. And obviously, it helps to have somebody like me or people in my team that actually are fluent in the language of the investment bank or the language of capital markets. Right? I think some clients often get fairly frustrated with consultants and their PowerPoint slides when they remain extremely generic. And their language is very consulty, right? That can be frustrating to an investment banking client. So to be able to speak that language, that's where that's kind of important. So I'd focus on the second group because I think that's where most of the transformations in the markets businesses and the investment banking businesses were relevant. And I think what we saw there was a couple of things. We moved very, very much over the last 5 to 6 years from what I would call product-centricity to client-centricity. So even the organizational structures of the bank, we were collaborating on transforming them from product silos to client silos. Look at some of the regional banks in Europe, you'll see they're actually set up by client and not set up by product anymore. Creates all sorts of interesting challenges around P&L reporting, et cetera, and double counting. But the idea is you want to show your shareholders that the client comes first, that you are Also using clients for risk management. It's not about taking positions. It's not about, leading with risk management in a proprietary way. It's actually about working with your clients to take you out of risk, right? So that's actually the fundamental, that's the fundamental philosophy around running a client-centric business. And sorry, go ahead, Mark.
No, I was going to say, so switching from product-centric to client-centric, what were some of the missteps that you saw a lot of others do, or what are the things that you said, hey, if we do this, we'll really have a great output on the other side by
Yeah.
switching models into being all about the client?
Yeah, I think first of all, it's about knowing the data. You have to, I think there's a very, what we found at a lot of banks is there is no real golden source of truth around how profitable or how valuable a client really is across the entire bank. So how do you actually capture client data in a way that it's available for managers at the top, and then obviously for producers at the bottom, to be able to make sense of, to actually understand what is this client really delivering, and also what are they using, how much of our capital are they using, how much of our time are they using. You remember Morgan Stanley, client-centricity was tackled fairly early, 2015, 2016.
100%.
Very, very painful exercise on the one hand, because it was also about who is a client and who shouldn't be a client, and what did we do with the tail, and all these types of things, which can be quite sizable management challenges. But I'd say the bulge bracket went through that probably 10 years ago, and the rest of the of the banking world is going through it now, or at least starting to tackle it now. So knowing the data, how much capital does your client use, how much balance sheet, how much of people's time, how often does management have to dance down there and kiss the ring and all these types of things. That's very, very important. The second thing is to understand the difference between revenues and profitability, right? If a client might do a lot of business with you, a lot of volume, but it might not be the stuff that really works for the bank, right? And everybody thinks they're a great client, but actually, when you really, really dig into the numbers, the resources they actually use might be more excessive than you think, right? So understanding what real profitability is. If you lend them $1, what are you actually getting back on that dollar across different products, et cetera, et cetera?
Yeah, the wallet versus the perceived wallet.
Yeah. Then I think there's a few cultural things that are important for coverage model optimization. One is to be able to have a culture of asking for the business, right? I mean, I think at Morgan Stanley and generally in the bulge bracket firms, good salespeople are generally fairly aggressive about asking for business. I don't think it's so much a problem in the tier one, but I do think as you move down, let's call it the intensity of the capital markets organizations into more the regional banks and these types of things, there isn't a culture for aggressively asking for business. You sort of, you have a relationship with your client, but goodness me, if they're not delivering, one, you might not know it anyway because you don't have a holistic view of the data. And two, God forbid you actually ask them for something. That's a really dirty thing to do. So let's not do that. But it's not just about asking for business, it's asking for business that you're really good at and that you really want and that your division wants and potentially that your bank wants, right? It's not just simply I'd like more foreign exchange spot or I'd like do more govies, right? Look, we're really, really good structured finance, and when you have something to do, you have to call us, kind of thing, right? But we also need to earn that right about from having the right relationship metrics and things working, et cetera, et cetera. And I think the last point would be on that vein is that clients are not predatory; they actually want you to do well, right? I think what I learned a lot at Morgan Stanley, for example, the concept of the broker review, right? It's not just about looking at the data. We number 5, we number 4. What's our rank? What's our share? And these types of things. It's also how is our research? Do you have access to the traders? Do you feel like execution is seamless, the whole customer journey from trade to post-trade and all these types of things? Are you joined up as a firm, right? Can you deliver senior management, right? There are some intangibles as well that the clients really appreciate. So they actually want you to do well. It's not like they want to get the best price and make sure you're hurting and you never make any margin on anything. They want it to be mutually good. And I don't think everybody always understands that.
Yeah, there's a lot more to the trade and the relationship than
Oh,
just the
sorry, one
price.
last point. And then the
Yeah.
incentives, right? I mean, if you really want to be successful, as a bank with your clients, you have to have a holistic view of the client contribution across the group. And you have to look beyond your product silo, but you may not be incentivized to do that, right? So you might work for a structuring desk and you get paid on the basis of the business you deliver into that desk. And that's it, right? But can you get some accountability and can you get some compensation on the basis for that client doing well across businesses?
Yeah.
Right, and setting up the incentives to be able to do that. That's sort of the nth degree of this kind of thing.
It's funny, like as a trader, you sit in a silo and you're trading with client X, Y, or Z. And sometimes you're like, okay, well, these trades in, let's just say, investment grade credit or high yield credit, aren't really creating wallet for me. And then if, you sit down with a senior leader and they come into you and say, hey, listen, just so you know that our number 3 equity client in the wallet's X. It's a big benefit for you to continue to, showcase that these are really a tier 1 client for a lot of other reasons that you're not even understanding. So
Yeah, and I think the benefit of the consulting angle on this whole thing is on the one hand to be able to benchmark clients around how they're doing in this space.
Yep.
And then secondly, to provide a path to execution. I remember the exercise we did at Morgan Stanley 10 years ago. It took a lot of people off the desk, right? With the consulting firm that was providing the numbers and looking at the rank and share. So how do you build trust with a banking client to be able to take that work off them, right, and help them with the execution process?
Yeah.
So that's really where I think the consulting angle comes from on this.
We always talk a little bit about technology and electronification on these podcasts because we think it's extremely important in terms of market structure. And, you've been in Wall Street for forever in multiple senior roles. More on a high level perspective, you don't have to get too granular, but how have you seen the shift or the use of technology change and evolve, in your time, both at Morgan Stanley and then at BCG?
Yeah, be careful on this one because I've been out for 7 months now, and that's a space that obviously moves so fast.
That's right.
3 years worth of evolution has probably happened while I've had my feet up for the last 7 months. But I would say, yeah, maybe more over the last decade or so. I think if we sort of look at it between trading, sales, and then more private solutions and these types of things, I would say on the trading side, there's been this evolution of automation that starts in the simple products, right? Flow first, particularly equities and FX, govies, agencies, and swaps, where you have this sort of trader to quant ratio, right? Trader being guy who makes the prices, sit on the desk and manages the risk, and the quants do the modeling and help the systems and all these types of things, where that ratio gets flipped on its head, right? 5 traders to 1 quant 10 years ago might be 1 to 5 today, right? That's sort of how this thing, um, I would say, transforms the structure of a division. I think over time. So on the trading side, I think the automation has slowly come up the what I would call the complexity curve. Credit came later, and I would say still not. You know this better than I would, Mark, but I'd say still not fully evolved.
I would agree.
And then ultimately you'll have discussions around some of the more solutions. I'll get to that in solutions and private side types of businesses, which I'll get to in a second. In the sales side, my observation is obviously that the personal touch has diminished, particularly in the fixed income space through the development of Bloomberg Chat and other things, right? Pricing has become probably a bit more honest, but it's become also harder to build personal relationships. I think where salespeople, particularly in flow spaces, can now differentiate themselves more than they could in the past, was not really access to trader or pricing. I think that's all completely commoditized now, but more, do we provide execution excellence? Can you count on us really to give you a proper customer journey that you need, et cetera? And do we have proper client metrics where we really understand what you're doing, right? And there, I think automation and digital development in terms of being able to crunch data and tell you more about the qualities of your client, I think is much more valuable now, right?
Yeah, if you have a salesperson who can now focus on bigger picture things, whether it be the $2 billion portfolio trade or the book of business of saying, hey, to your point, hey, we're really good at trading pharma. Next time you have real pharma trades to do, let's get on the phone with our analysts and talk about big picture stuff. Let's let the 5s and the 10 million stuff trade more electronically and focus on bigger picture things. I'm kind of in agreement. Automation is actually here to help people's workflow, not to take it away. A lot of people thought differently, but if you look at the equity market, even as they've evolved, volume skyrocket, institutional sales traders are still there, just doing things that are more pure value add than a lot more of the, hand holding, quote unquote, stuff that's on the smaller size.
The question for me, and this is also the question around AI, is not, does it make you more efficient if you set it up right, or does it make you more productive? It does. The question is really, what do you as a bank decide that you want to do with those productivity gains? I think this is a big question in IBD, for example, where, the analyst is essentially at very mundane tasks until 4 o'clock in the morning. A lot of them can be taken over by AI, but what do you want to do with those, with that released efficiency? Do you want to improve costs and fire people?
Right.
Do you want to give them time back so that it's only 11 p.m. and not 4 a.m. or whatever that might be? Or do you want to ensure that they're working on higher quality stuff? Maybe it's a combination of all of them, but that's a fundamental strategic cultural decision that a firm needs to make around, I would say, the efficiencies that they gain from either automation or AI, whether it's in the trading or the sales on the public side, or whether it's in the solutions, the M&A side on the private side, right? What do you do with those, with that release productivity? How do you put it in the service of the bank in the best way? And I think some banks are struggling a little bit with that, which is on some level keeping them fairly micro around automation, particularly around AI. Other banks are doing it better and scaling.
Yeah. I think what you just said is a great clip and a great soundbite for this podcast. Is basically, what are you doing with the gains from AI if you're seeing them? How are you spending the time, resources, or hopefully the money freed up from doing it? Transition a little bit more directly about your career. Digital transformations in the wholesale banking arena. Where have you seen these transformations succeed, and where do they tend to stall? And this is something I know you spent some time with. So if you wouldn't mind talking, this is more about strategy and the transformation of asset class.
Yeah. It's all about the value they're creating and whether or not you can measure it. I've seen a lot of banks that have been seduced by the idea they need to go agile, and they do.
Yeah.
It's it's a very, very powerful tool for efficiency. But where it goes wrong and has gone wrong is that the KPIs or the metrics against which they're measuring themselves are actually not that meaningful, or not that understandable, not that understandable to executives that need to buy into it. So, for example, if you're just focusing on time to market or velocity or employee satisfaction or client satisfaction, in other words, the agile process on these 3 work streams was extremely efficient because our time to market was halved, and our customers love us for it, and employees really enjoyed working on it. That's not enough, right? It has to, it has to have essentially one of 3 outcomes, or all 3 of them, right? Did it make money? Did it save costs? Or did it reduce risk? And how do you measure that? So how do you say, relative to a normal process that we did in the past, whether or not a process that is running, let's say under agile conditions, has actually made more money? Having a mechanism in place to be able to determine that is really, for me, the measure of whether that kind of transformation will ultimately be successful, because that's the only way that a CFO or the real leader or the business leadership will take time to focus on it. Are you making money for me?
Yeah.
So and the firm can rally around that concept when the bottom line is positive.
Right, when the bottom line is positive.
You got to find ways to measure it and convert it into metrics to the raise comp.
Yeah. The raise comp, and also to make the executives' decisions a little easier to go forward with project X, Y, or Z, right? Has to be not a no-brainer, but you have to see what the fruits could be of the plan.
And we worked on these types of projects, and I think that was one of the big learnings, is that there are, these things are fairly complex to set up, and set up these centers of excellence where you're really having all these sort of grassroots agile initiatives housed under some standardizations, and consultants are very, very good at consolidating these types of things and putting frameworks together around how to fund them, around how to set up the agile ceremonies and all these types of things. But what came later out of a lot of the learnings was really about how to translate a lot of the gains that were made on the velocity side, et cetera, into real P&L or into reduced risk.
Yeah, it makes total sense. I guess my next question would be in a similar light, but we kind of hinted at this earlier about going to client centricity. And how would you say the relationships between senior institutional clients and investment banks has evolved or changed over the last, let's say 10 or 15 years, as more people have become more client centric out away from maybe product centric? What's the relationship then between and the use case between investment banks and, large institutional money managers?
Yeah, I think going back to some of the things we touched on before, I think the focus on mutual value is this relationship also benefiting us as a bank, and do we actually have the right metrics around that? Are we solving for profitability with the client rather than just volume? Does the client move us out of risk? A lot more focus on that these days than there used to be.
Yep.
From the client side, does the bank provide us a strong vertical platform um, that builds trust? So it's not just about good salespeople or good prices. Is the system going to crash? Is it reliable? Do I get good post-trade service? Do I always have access to somebody who's going to help me when something might fall between the cracks or whatever it might be? So just having that proper platform vertical that a client feels is also execution excellence, not just pricing or intellectual excellence, I think it is quite important. I think relationships have become somewhat more quantitative and less qualitative over the years. That was at least my perception as I left Morgan Stanley a good 8-9 years ago, where things were going. Everything's measurable now, and I think those firms will have a competitive advantage that are able to consolidate that measurability into really meaningful types of outputs and conclusions about what to do with clients. If you have a good overview of the lending profile of a client's business, then you have a good handle on the types of structured finance solutions that you can provide, or derivative value that you might want to introduce into that relationship, right? So being able to be connected across divisions and across product silos in the service of a single client is now, I think, much more important than it was 10 years ago. So do we deliver the whole bank? Do they know our senior management? Are we joined up for them, et cetera, et cetera? These things, I think the really, really best banks are excellent at this now. And I think years ago, it was not so much in focus.
Yeah, I guess you kind of answered a few of my questions along there. That's great, and I totally agree. You spent a lot of time leading teams in senior capacity and at BCG doing the same thing. You know, and now you're doing some advising work and some consulting work. How do you coach senior leaders about navigating, their demands, their client demands and internal demands? Like, what is the process you have with your clients when you're more coaching or advising them currently?
There's different types, right, of executives. I mean, you look at a firm like Morgan Stanley, it's probably true for Goldman and probably true for JP Morgan. A lot of the leadership at these banks is homegrown. So the people running the businesses have a good idea of how the bank works, how it's evolved, around how to navigate across divisions, and bring people in where it's important outside of their own isolated responsibility. So that's one type of executive, and that's a specific need that they might have. I'll come to that later. Where I think the value we create for those executives might be, and then the other banks often hire externally to build their leadership. That can be problematic because you come into the bank with a mandate for change or transformation, and you might have learned how to do that at your own organization, or you might have been in an organization that has been very, very successful over the years and hasn't had a big change management program as a result. So then coming into a new organization that kind of needs it and not being able to navigate it can sometimes be quite difficult. So we work with these types of executives on that type of onboarding where we get asked, of course, we don't always get asked, in doing proper due diligence on organization capabilities, working between silos, incentive programs, sort of some cultural types of input based on what we see in other organizations. I mean, the value has to be in some form of objective benchmarking, not in subjective advice, right? It's sort of, we've seen this here. That's
Something
how they
concrete.
navigated this. That's how they were successful. We've seen that there. That didn't work at all for this, that, and the other reason, etc. But I think where most executives go wrong, particularly when they come from the outside, and many of them see a big opportunity, right? I think I've seen a lot of executives move from some of the top banks on Wall Street, where there has been a transformation, and also personally they benefited from it because the share price appreciated over time, where they see an opportunity in another organization where the valuation might not be that interesting, and they're happy to take on that challenge, but sometimes run into frustrations 12 to 18 months down the line because the bank has a different culture. It moves more slowly. It's more political. It's more difficult to get people incentivized, or you don't have the comp tool or whatever it might be, right? And just really having a bit of patience, despite the fact that you might have a change mandate and want to make things happen quickly. Yeah, it's a question of pretty maturity on some level, right?
Yeah. The devil you know versus the devil you don't know, in a sense. You know, and
We have,
wrapping.
I mean,
Yeah.
you know, that's we actually spend a lot less time on that sort of thing. I think again, where we were, at least when I was at BCG, we would get hired essentially to be able to comparatively put a bank into context. There are other areas of, let's call it, CEO advisory or senior executive onboarding that specialize in integrating executives into new organizations. So that's just an observation from afar, essentially.
If you're advising somebody right now who just started on the job day one, let's just say at a tier 2X bank, who maybe worked at a tier 1 or whatever, what are the first 3 things that you'd want to speak to this individual about right now to make priority?
Well, I'll tell you what I would have done a year ago, because again, I think things have. I mean, the hugest difference today, um, I think between now and maybe 12, 18 months ago, is that the bank valuation has improved dramatically over the last 12 to 18 months. There were a handful of large global institutions that 12 to 18 months ago, let's call it 12 to 24 months ago, were trading at something between 30 and 50% price to book.
Yep.
Big problem, right? So the advice there would have been, your investment bank is potentially the largest user of RWA. You are the CEO topic here. You are the shareholder topic. How can you, as an IB leader, drive the valuation of the bank? Right? That's the conversation we would have had 12 to 24 months ago. Right? How do you tackle earnings volatility? How do you make sure you're cross-selling better? How do you have a clearer strategy? How do you make sure that people understand that you have execution credibility? How do you deal with expected ROE? Be ruthless about your business selection. So ensure that you can compensate for doing business in areas that are great for the entire bank, but maybe not necessarily for your individual division. You know, that was one thing. Then we would also have a number of discussions around how to participate in the private credit boom. Right? A third one, a very big one, and that's even relevant today, and I'm sure it is, how do you actually make the balance sheet more efficient? How do you create more balance sheet of velocity? Topics like credit portfolio management, originate to distribute. Do you have that? Do you have that under control? Do you have a concept around that? Is your ALCO properly populated? Do you have a proper loan decision mechanism that
Yeah.
actually takes into account the payback against that loan, etc.? Right. That's so, and then the third thing that I would say for an executive is do a deep dive on clients. Spend time knowing them properly. Particularly if you're coming into a role, right, or
Yeah.
particularly coming from the outside. Just get in front of clients and make sure you're visible to them and they know what you stand for.
Well, the good news is the price to book in the last 12 months has skyrocketed. You know, yeah. So, you know, for people working at some of these financial institutions, still their deferred is a lot rosier place than it was before.
Yeah,
Um,
but that's the bet that some executives made, right? They've had a good a successful run at an organization for a long period of time, and hopefully have written a good equity story, and want to be able to take that experience in the service of a bank that may still have that ahead of them, right? And I think that's probably working out now.
yeah, the credibility thing that you mentioned, I think is key, right? Credibility and then durability allow shareholders to get on board with your story. And you've seen a lot of of institutions diversify their revenues into more what I would call stable revenue stream outside of just banking and trading operations. So, with the volatility we've seen this year, yes, you've seen a large uptick in trading. However, the investment banking and M&A markets are still, pretty subdued. So, but just being able to still produce these numbers it shows more stability and diversification of revenue streams, which I think is
When
helping.
you call it, again, you say revenue streams, right? That's an interesting point.
Yeah,
It often comes back to the fact, and I've seen this a lot, is that a markets division or an investment banking slash markets division might be the largest revenue provider of the group. And but they may not be the most, they may
profitable.
not have the highest return on RWA. And then to be able to to be able to then be willing to sacrifice some of the RWA usage for areas where it might be put to better use is a difficult and tricky discussion to have, because a division, again, might be the best revenue producer of a group, and as a result has a sort of a cultural presence in an organization where it's hard to actually move away from that. And I think sometimes the um, the seat at the table issue of a markets division or an investment banking division needs to be more positively addressed, right? I think, and I remember this also during my time in the fixed income division. These were the hooligans, right? That can probably blow up our clients, right? God, we don't want them to have a seat at the table. Let's keep them out. Let them do their thing in their little box. Just make sure that they're contained now in the post-crisis world. Some of that culture still exists even today, where you keep a markets division at arm's length, but you can't do that anymore. They need to have a seat at the table on
That's right.
ALCO. They need to be in the loan decisions. They need to have public-private sensitivities notwithstanding. They need to be in the flow of the bank, right?
Yeah, yeah, they need to see at the table. So that's the meat of the podcast. The next and final section, I like to just call my quick hits. I'm going to ask you a few things. Just give me your quick take on them, and I've sprinkled a few that should be pretty fun, anyways. But some are just
Is it like a one-liner answer?
yeah, just little quick hits, like one liner, two liner. So I like to do it with everybody. It allows people to get to know you more as a person as well as a senior executive. So, what was? I'll start with an easy one. What was the first aha moment in your career where you were really excited to be on Wall Street?
So many. But I think the main one came later in my career, and that's actually how consulting really works. Right? The transition from banking to consulting, I would say, was the hardest thing I ever did. And getting to grips with the nuts and bolts of that business, how that actually mechanically works. Once I got that, that was a bit of an aha moment. I had wrong misconceptions going into that industry. I had some fantastic mentors and sponsors who helped me through it, but the first 6 months was a tough transition because I actually realized I didn't quite understand the business.
I love it. What's the best piece of career advice you've ever received?
Listen more.
Listen more. I like it.
Listen more.
If you
We
could,
still need to follow that.
trust me, we all do. If you could start your career again today, what would you do differently, or would you go into a fully different field?
I wouldn't change the field. I think banking at the time, and certainly markets and investment banking, smartest people, competitive, quantitative, analytical, again, the highest quality people you can imagine from any walk of life. Very, very fulfilling. Same with consulting. But I probably, I might change the style a little bit. I'd perhaps be a bit more linear. I look back on my career, I always felt like I was always thinking, what's next? What's next? What's next? Moving from one thing to the next. And I think there's some value to be had in staying the course on certain things a bit more. So perhaps having more of a linear trajectory than always zigzagging from side to side might have caused a bit more peace and balance in through the course of my career, I think, and less stress.
I would agree that the people that you work with in Wall Street are some of the brightest and most talented, as well as the pace and the environment and the collegial nature after you leave college and university. You kind of stick in this collegial university feel for a long time, and you become very close to even almost a second family. I mean, you spend enough hours with them there where they really are your family away from home too. So I agree there. You've traveled around the world. What's your favorite restaurant on this gorgeous earth that we live on?
It changes right now. It's a steakhouse in Frankfurt called Buffalo.
Buffalo.
It's my favorite place to go. Yeah, they have a 900-degree hot grill, and they have the best steaks, and it's reasonably well priced, and not everybody knows it. So that's where I like to go with the family. That's probably right now my favorite. And then there's a couple of places in Tokyo. I don't remember the names that I could say this was the experience of a lifetime. I mean, there's been so many.
So for those of you who don't know, obviously, I should have mentioned this in the beginning. Frankfurt, we're talking about in Germany here, not Frankfurt, Kentucky. So, so Frankfurt, Germany, Buffalo. If you're ever in Frankfurt, hit the restaurant Buffalo. And then last but not least, when you do go to Buffalo or another restaurant, what's your cocktail, wine, or beer of choice? What do you order when you sit down at a restaurant right now?
Yeah, I order what's called a wheat beer, a Weizen beer.
Okay.
You ever heard of that, Mark?
Yes, I have. I went to I was actually blessed. I went to Oktoberfest a few years ago, and I had a few, and a few.
That's always a life-changing experience for people who aren't from Munich. Yeah, no,
Yeah.
we usually have a wheat beer, but if I'm feeling like spending a couple of hours at the restaurant, I'll probably get a bottle of red wine.
I like it. Tim, I really appreciate your time today, being on the cast, and honestly, I also appreciate your mentorship over the years. To me, it's been very helpful, and we really appreciate spending some time with us today.
It's great to see you, Mark. Thank you so much. Good luck with the podcasts and everything else you're doing.